I think you see a lot of dispersion of returns, both from a geography perspective, from a sector perspective, and ultimately from a stock perspective. And so it creates an opportunity for active management to really create alpha. Obviously, it's you have to stay on top of the different trends, locally, regionally, and globally. But I do expect that, as we talked about, we think it should be a good setup for listed real estate in 2026 and would expect good opportunities really across the globe.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. I'm pleased to be speaking today with three members of Citi's global real estate team for our annual look at regional trends and sector performance. On the line is Nick Joseph in the US, Aaron Guy in the UK, and Howard Penny in Australia. Welcome, everyone.
Thanks so much for having us, Sarah.
So let's kick off with a high-level overview of Citi's assessment of global real estate performance in 2026 and the key themes that are influencing results across different geographic regions.
Absolutely. So we're actually here at Citi pretty constructive on 2026. We put out a report recently looking at a 2026 global outlook. And the overall expectation is for higher real estate stock returns this year versus last year in 2025. You asked about key themes that are influencing. Obviously, it really does become dependent on local geographies. Real estate is local ultimately. But the one key theme across everywhere is supply and demand. And I would say the supply picture broadly is more encouraging globally. We can come back on the US, which is about 55 to 60% of the index. But the supply picture has started to come down, which is encouraging broadly. Of course, demand matters as well. It does look solid. We rely on Citi's economists, and they're broadly constructive on global growth in 2026. And from an equity strategy perspective, Citi's equity strategists are neutral real estate within their space. Overall, there's obviously policy unknowns. We saw that pretty impactful in 2025, both from trade policy as well as immigration. Interest rates will continue to matter. Capital flows, where capital is going in terms of the transaction market. And then required rates of return and how that compares to alternatives, because ultimately listed real estate is listed. They are stocks. You're competing with capital for other uses of it. And we're constructive on real estate, and it's been a good start to 2026 thus far.
Right. And can you break down broader global performance into the regions and sectors where Citi is most positive?
Absolutely. So in the report, we try to lay out each of our regions across the globe. I'd say overall, we are expecting higher total returns in 2026 in the US, Europe, Latin America, Singapore, Thailand, and the Philippines. In Australia and China, we're expecting about similar performance this year versus last year in 2025. Then we're expecting weaker performance this year in Hong Kong, Japan, and the Middle East. From a sector perspective, it really is varied. If I pull up the figure we try in the report to look at each subsector and roll up from geographies. What's interesting is diversified actually comes up as the most preferred and least preferred sector. And so that really tells you that geographies and specifics matter. Residential is also one of the most and least preferred. And then retail actually comes up as more preferred globally relative to least. The other sector I would call out is industrial. That is on the most preferred list that comes up from our global analysts. We also surveyed each of the global analysts to see what was the key driver of preferences from a stock and sector perspective. Not surprisingly, it's rent and revenue growth. And so we see that in the US, but really a focus on top line growth. And that seems to inform most of our recommendations.
And turning to US REIT specifically, what are your growth estimates for this year and what factors are supporting that growth?
We think, as I mentioned, REITs are well positioned in the US for 2026. So we're assuming about a 10 to 15% total return. And so that's driven by about 6% earnings growth and about 4% current dividend yield. And so that gets us towards the low end of our expectations. To get to the higher end, you would have slight multiple expansion or conversely, slight cap rate compression. What's driving that? We think a few things. Number one, solid year-over-year earnings growth. As I mentioned, about 6% is pretty good for REITs. Lower supply deliveries. You've seen the supply pipeline really come off. Over the past few years, we've been talking a lot about industrial, Sunbelt apartment, and life science supply. The only sector that we think is still really delivering is life science right now, and even that's starting to come off. Not to say you aren't dealing with the residual of some of that pipeline, but overall, kind of what is being introduced in terms of new stock has really come down. And we think valuations are attractive relative to equities. REITs look a little better than they do to fixed income. And REITs trade at a slight discount to NAV on a straight line basis right now. So we think valuations are supportive to gather more interest in the space. I will say we think the range of outcomes remains wide. Obviously, there's policy implications, there's interest rates, there's uncertainty around the economic growth. And the one thing I always remind people is that REITs don't all trade the same. And so we have a good chart that we look at the top quartile and bottom quartile of REITs in any individual year. It's almost 50 percentage points. So there's massive dispersion within the index. And that's really what gets us excited about different REIT opportunities, because different stocks and different sectors will perform differently and create a lot of different alpha generation opportunities. So if I think about the sectors where we're most overweight in our model portfolio, the top right now would be industrial REITs, followed by healthcare, which is really driven by senior housing, residential, and then infrastructure, so both data centers and towers.
And what do you expect US REIT management teams to be most focused on this year?
It's a good question, because I think what will drive the stocks most are the property level fundamentals, KPIs, and the potential inflections. But that's hard for management teams to kind of change in the near term. Obviously, their decisions will impact their portfolios and those growths in the outer years. And so right now, I think management teams are probably most focused on making the right capital allocation decision, kind of controlling what they can control. So you see that from acquisitions, dispositions, development, redevelopment, starting to see more stock buybacks given some of the dislocation. Obviously, management teams will remain very focused on their balance sheets and leverage levels, and I think ultimately growing dividends sustainably.
Aaron, turning to you, Europe's real estate cycle is seeing positive subsector and macro support for the first time in over 5 years, according to your outlook. What are the factors behind that?
Yeah, thanks, Sarah. Look, we've had quite a number of challenges over the last sort of 5 to 10 years. And most recently, obviously, the pandemic and then inflation with high interest rates. So that has caused a sort of cyclical end. And actually, we're starting to see more positive signs as economic growth kind of stabilizes to a more positive outlook, and interest rates have calmed down with inflation becoming under control. So the broader environment has moved from that sort of end of cycle sort of transition into the beginnings of the next. And obviously, the subsectors are very different in terms of their underlying rental value dynamics. But as a broad comment, that's where the sector's at. And for the first time in 5 years, as you said, we're having consistent expectations for total returns for the group overall. The last few years, we've seen negative to flat expected total accounting returns for the stocks. And this year, 2025, full year into 26 and even into 27, we're forecasting total accounting returns for the companies are double digits, so north of 10%. And I think more importantly, particularly for generalist investors, the consistency of those returns, or the volatility, the standard deviation of those expected returns has come down. So you've got a higher return expectation and a lower volatility for the group. So overall, as much as there are subsector differences, we're becoming increasingly constructive on European real estate.
So, Aaron, what are a few European real estate sectors that most interest you at the moment?
Yeah, there's a few different sectors that come to mind. Overall, we've shifted from prominent sort of sell recommendations from 2019 onwards to predominant buy recommendations now. But within that structure, some areas we think of probably going to become increasingly positively focused. UK shopping centres, we think there's potential for a turnaround there. Self-storage, prime office and prime office development is another area that we're particularly positive on. Industrial logistics and data center and that triple net lease environment is one that we're positive on. Healthcare, and finally, one that hasn't performed from a stock point of view, but potentially has a bit of a rental inflection. German residential is the other area that we have a look at on the positive side.
And would you say that European real estate stocks are seeing some of the same valuation issues as US REITs?
Certainly in Europe, the stocks, they're not trading at distress levels, but they're certainly trading below average levels and certainly not at multiples that you would expect the stocks to trade at in a growth cycle. So you can argue that the stocks are somewhat undervalued, particularly as the fundamental environment is looking more positive. So we think that offers investors an interesting inflection point, because some of the potential valuation discounts that we're seeing in the sector could resolve where we've got significant double-digit, in a lot of cases, north of 20% expected returns for the stocks over the next year or two. So yes, the stocks are trading at what I would call overall pretty low discounted levels. But we think that valuation could significantly improve. And particularly as well, when you're considering the correlation with some sectors like tech stocks, which we talked about in our outlook, where historically real estate stocks have operated on a different cycle as well. So real estate in Europe feels like it's in an upward trajectory and could benefit from some other corrections elsewhere as well.
Howard, turning to you, how are real estate fundamentals looking in the Australian market, and will expectations of higher interest rates impact the overall outlook?
Yes, thank you for the question. So here in Australia, we've got two conflicting forces. One thing that's different about Australia is it's one of the few countries in the world where we've just recommenced interest rate hikes this week. And as we pointed out in the report, that is attracting capital away from Australia generally into regions where perhaps there's a more supportive cost of capital. But the other conflicting force, positive force in Australian real estate is that we have very strong underlying fundamentals at the moment. Australia is witnessing the highest population growth through immigration in developed economies. And this together with a relatively strong underlying savings rate that remains strong and positive is underpinning the demand for various types of real estate sectors. And that together with that demand is not being matched by supply. Supply has been very low. We've seen very little shopping centers built over more than a decade now. And areas like residential, we are building significantly less than what we should be. And so there's a few subsectors that are showing great demand-supply balance. And that's driving a stronger sort of rental tension and higher rent in this market. And so investors have these two conflicting forces where they see strong fundamentals that they want to invest in, but they, of course, are trying to balance that with a cycle that has just turned. Our economists are expecting one more rate hike of 25 basis points this year after this week's 25 basis points hike.
And what do you see as the biggest drivers of Australian asset values this year? And are certain sectors more likely to see increases than others?
It's an interesting trend because the sectors are perhaps going to see different outcomes in our view. And so we are looking at where are we seeing the greatest interest and where are we seeing the greatest fund flows into the subsectors. And one area that's been surprisingly strong in raising capital is actually the retail sector, where we've seen funds like Charter Hall raising $2.5 billion off initial targets of $400 to $600 million of equity capital looking for retail real estate assets. And this together with a number of transactions in large assets of the Westfield Group, where they've been selling down percentage stakes in their assets at very low cap rates compared to historical levels. And beyond that, we've seen a number of other transactions where we've seen international investors buying retail assets. And as I mentioned, they're being attracted by that strong fundamentals of that subsector. So that subsector, we're expecting to see cap rate compression and valuations supported with those fund flows. But there are other subsectors with lower growth and less interest from investors at the moment. And perhaps this interest rate increase is placing a little bit more negative valuation pressure. And that offers, for example, although we do think we've turned the corner on that sector, it perhaps just does remain at the bottom for a little bit longer.
And where do you see the biggest opportunities for Australian REITs this year?
So it's in those subsectors where we see good fundamental underlying growth at a reasonable price. Retail, for example, is one idea where we see the strong fundamental growth, and currently the shares are at reasonable prices of around 14 to 15 times PE. Within Australian terms, that's around the average level for REITs. And then we've also seen a sell-off in residential stocks from October when inflation started surprising slightly to the upside and the interest rate outlook changed. And residential stocks like Stockland is another idea which we have seen as a top pick, where we have a strong undersupply of housing, and Stockland is a key large supplier of that to the market and should see growth. And finally, similar to what Aaron mentioned earlier, data centers remains a key focus in this market in global expansion. And we're seeing this year, the data center stocks in Australia are starting off at more reasonable valuations of around 21 times for Goodman. And that remains our top pick, considering that relatively cheaper entry point compared to history and very strong potential growth if they execute on their data center pipeline.
So putting all of this together, how does the variability in geographic and sector preferences that you expect this year translate into investment opportunity going forward?
I think that's an exciting opportunity. I think you see a lot of dispersion of returns, both from a geography perspective, from a sector perspective, and ultimately from a stock perspective. And so it creates an opportunity for active management to really create alpha. Obviously, you have to stay on top of the different trends locally, regionally, and globally. But I do expect that, as we talked about, we think it should be a good setup for listed real estate in 2026 and would expect good opportunities really across the globe.
Anything that we didn't cover in any other questions that you want to add?
As I said, I do think that the broader themes, right, interest rates, capital flows, policy, valuations, it's very important to really stay on top of all of those at this time. But that's true for most years. I do think the policy risk has increased globally. And so that's one thing that we've really tried to stay on top of. But the other key themes that drive real estate and required IRRs are pretty consistent across years.
Thank you, everyone.
Thank you for having us, Sarah.
Thank you, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.